Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. April is Financial Literacy Month, and we will be covering a wide variety of topics to support the cause. Joining me is DiGangi, Senior Editorial Director at The Balance, with a guide to college savings. And Christine, I think the most obvious question is, when should you start to save for your child's education?
You cannot start saving for your college education for your child too soon. Start immediately. And if you didn't start immediately, don't freak out. Just get going because the power of compound interest is definitely in your favor. If you're thinking about your child going to school as early as maybe when they're 17 or 18, you only have so many years to really build up that fund, and college is pretty expensive.
It sure is. What's the best way to save for college?
There are a lot of different ways that you can save up for college. You can, use a savings account, but there are some other ways that are more tax advantaged or maybe have better returns. So you're going to want to look into maybe a Roth IRA or a custodial account, maybe some specific education savings accounts. Most states have a couple of, if not one, just one, 529 plan that helps you save up for college and even primary school education in some cases.
And the million-dollar question is, how much do I need?
Well, that depends where you're thinking of going, but as we've seen over the last decade, the cost of college has really only gone up and exponentially so. And you're looking at triple digits easily as far as your overall college education. A 4-year college education, even at a state school, could be more than $100,000. And then if you're looking at private education, possibly more than $200,000. And that's 4 years. When a lot of people take longer than 4 years to get through school. So definitely needing to plan on the aggressive side for how much you're going to need to pay and save.
And starting earlier means you have less principal to put in the beginning because of that compounding interest you were talking about.
Right, right. It will build over time. And as you earn interest, you can eventually, earn interest on that interest. So it's really important to keep those funds growing and safe, not dipping into them for emergencies because it's something kind of like your retirement plan. You really need that time to let it grow so that you can dip into it when the time is right.
All right, Christine, thanks for joining us for Financial Literacy Month. I'm Jill Malandrino, global markets reporter at Nasdaq.